Hey guys, I hope you all are doing great. So what's the hot topic in industry right now? Yes, of course, it's the new labor code, guys. And what's the most important part in the new labor code? The gratuity provisions. And you know what? Many people are lacking clarity on how gratuity is going to impact the financial statements of an entity, whether the impact should be taken to P&L or other comprehensive income. There is a lot of lack of clarity among people surrounding this. You know what, guys? Just give me some time and I'm going to break every single thing down with the help of numbers. Let's dissect every single number there is and let's understand this from a practical standpoint. So what are you waiting for, guys? Sit back, relax, and enjoy as we deep dive into this, right? Just a minute. I'm just presenting my screen, so do let me know once it is visible. Just a moment. Just a moment, guys. Yep. I hope my screen is visible right now. Yes. So without any further ado, let's just move on, guys. So basically, first, before understanding what is the impact of gratuity on the financial statements, first we need to understand something that is very, 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 very important. The definition of wages as per the new labor code. So once we understand the definition of wages as per the new labor code, I will explain to you the relevance of this, right? So basically, what do they say? Wages means all remuneration, whether by way of salaries, allowances, or otherwise expressed in terms of money or capable of being so expressed, which would, if the terms of employment expressed or implied were fulfilled, be payable to a person employed in respect of his employment or of work done in such employment and includes. So it is basically saying that each and everything in the world is wages. And it is saying it includes these items: basic pay, DNS allowance, and retaining allowance. So if the definition had gotten over here, we could have concluded that okay, each and everything in the world is wages. But no, guys, that's where the definition comes into play and says, but does not include any bonus payable under any law for the time being in force. So basically, this refers to your statutory bonus. So basically, it is saying that your statutory bonus should not form part of wages. Next, the value of any house accommodation or the supply of light, water, medical attendance, or other amenity or of any service excluded from the computation of wages by a general or special order of the appropriate government. So basically, they are referring to HRA here. Next, any contribution paid by the employer to any pension or provident fund and the interest which may have accrued thereon. So basically, they are referring to employer's contribution to social security benefits. Again, this should not form part of wages. Okay. Next, any sum paid to the employed person to defray special expenses entailed on him by the nature of his employment. Let's say in IT companies, let's say they give you mobile allowance. So what they are saying is the mobile allowance is given for the purpose of your work. So what would happen is this again should not form part of your wages. That is what they are trying to say here. I hope that is clear. Next, house rent allowance, HRA, should not form part of wages. Next, remuneration payable under any award or settlement between the parties or order of a court or tribunal. Again, this should not form part of wages. Overtime allowance should not form part of wages. Next, any commission payable to the employee should not form part of wages. Next, any gratuity payable on the termination of employment. So gratuity again should not form part of wages. Okay. Next, any retrenchment compensation or other retirement benefit payable to the employee or any ex gratia payment made to him on the termination of employment. Again, these items like retrenchment compensation or your retirement benefits payable at the time of termination should not form part of your wages. Again, right? Next, provided that for calculating the wages under this clause, if payments made by the employer to the employee under clauses A to I exceeds one half or such other person as may be notified by the central government of the all remuneration calculated under this clause, the amount which exceeds such one half or the person so notified shall be deemed as remuneration and shall be accordingly added in wages under this clause. So I'm sure it was very difficult to grasp this part. So let's just look at a couple of examples. And once we look at them, you will get clarity on this part, guys. Okay. So some of you might have a doubt here. Okay, we talked about something called remuneration in this section. What is remuneration, sir? So remuneration is not defined in the new labor code, guys. Ideally, remuneration is the CTC, basically your cost to company mentioned in your offer letter, plus other entitlements. What might happen is sometimes companies might offer other entitlements which might not be communicated in the offer letter, which might be communicated later on through a mail communication, and that might be common for all the employees. Like let's say there is some allowance which the company provides to all employees, which is not communicated as a part of the offer letter, but is communicated later on after the employee joins, and this amount is common for all the employees. In that case, even though that amount is not there in your offer letter, that should be included as a part of remuneration. I hope it is very clear, guys. Okay, so let's say monthly salary of Mr. A is as follows: basic is 40,000, HRA is 20,000, LTA is, that is leave travel allowance, is 16,000, special allowance is 24,000. So the total comes out to 1 lakh. So what is the wage amount here, guys? Very simple. Should your basic be taken? Yes, it should be taken. Should your HRA be taken? No. We saw that HRA should not be taken. And should your leave travel allowance be taken? No, it should not be taken. In which point did they say no? Just a moment. I'll just show that to you. sorry, I think it was travel. Yeah, any conveyance allowance or the value of any traveling concession in point D. So again, your leave travel allowance should not be taken. Should your special allowance be taken? Yes. Why should it be taken? Because as I told you earlier, the definition says it means any remuneration and includes the following. And in the list of exclusions given below also, there was no exclusion regarding special allowance. So special allowance should be taken since it has not been explicitly excluded. So what does your total wages come to? 40,000 plus 24,000, 64,000, which is exactly what we've done here, guys. I hope that is very clear. Okay. Next, let's come to another example. There is a twist in this example. So just think carefully before answering this one, right? Just a moment. So let's say the monthly salary of Mr. B is as follows. Basic salary is 40,000. Your HRA is 28,000. Your conveyance allowance is 28,000. And your special allowance comes to 4,000. Okay. So what should be the wages for Mr. B? Okay. Basic should be taken, right? Should HRA be taken? No. Conveyance allowance again should not be taken. We saw that it was explicitly excluded, right? Next, your special allowance should be taken, right? You guys would say, okay, 44,000 is the answer. No, guys, here is the twist. This is where the point which we read comes into play. So it basically says that all the remuneration calculated under this clause, that is the wages amount which exceeds such one half shall be deemed as remuneration and shall be accordingly added in wages under this clause. So what they are saying is, basically, provided that the payments made by the employer to the employee under clauses A to I. So basically, where the items which are explicitly excluded from the definition of wages exceeds 50%, like for example, let us say my total remuneration is 100. Let us say the items which are disallowed, let's say my leave travel allowance, let's say my HRA comes to 55. So what would happen is, what they are saying is, so if this comes to 55, let us say the items which are allowed would come to 45. So I'll just write disallowed, allowed in wages would come to 45. What they are saying is, what is the excess over 50% in the disallowances? So basically the 50% of 100 would come out to 50 for me, right? The excess over 50 would be 55 minus 50, which would basically come out to 5. So what they are saying is this excess of 5 should be included in wages. So that is what they are trying to say, guys. So in essence, if you see, what they are trying to basically say is, all the items which are allowed to be included in the definition of wages should at least be 50% of the total remuneration. So coming back to our example here, so what has happened is, if you see the disallowances from wages, basically your HRA and conveyance allowance should not be included in the definition of wages, which comes out to 28,000 plus 28,000, 56,000, right? So, and what is 50% of remuneration? Your remuneration is 1 lakh, 50% of which comes to 50,000. So does your disallowance exceed your 50% of remuneration? Yes, because 56,000 is more than 50,000, obviously. By how much does it exceed your remuneration? By how much does it exceed 50%? By 6,000, because 56,000 minus 50,000 would yield a result of 6,000. Sorry. So basically, what they're trying to say is this excess of 6,000 should be added to this 44,000. So basically, your new labor code wages would be 50,000, right? Which is basically 44,000 plus your excess of 50% of remuneration, 6,000. So 44,000 plus 6,000 would yield an answer of 50,000. I hope this is very, very clear, guys. And I hope you got a clarity on this, right? So yeah. Now let me just clarify to you guys, why did we even compute something called wages? Guys, if you are aware, gratuity earlier used to be computed in the below manner. Gratuity earlier, just a moment, I'm just coming up. So as per the Payment of Gratuity Act and related rules, gratuity earlier used to be computed in the following manner. Basically, your last round basic salary into 15 by 26 into completed year of service. But now in the new labor code, what they are saying is your gratuity payable should be computed as follows. Basically, your last round wages, instead of last round basic, it is now last round wages into 15 by 26 into completed years of service. So now, guys, since the scope of wages is broader than the scope of your basic salary, obviously the gratuity payout which a company would need to make to its employees is going to increase. Yes, that is what I've said here. Since wages would exceed basic in 99.9% of the cases, assuming that is a case where your basic is equal to wages, it won't have an impact. But when would it happen, guys? Obviously every company would offer some special allowance to its employees, which would be included in the wages. So in 99.9% of the cases, your wages are going to exceed your basic. Very clear, right? So this would lead to an increase in your gratuity liability in your books. So this triggers a question on the accounting treatment, guys. So basically, guys, at this point of time or at this juncture, I would just want to tell you guys, just brush up your Ind AS 19 and come back to this video. Or if you remember Ind AS 19 to a decent extent also, you can just hang on in this video. You will be able to relate with what I'm saying, because from here on, we're going to be discussing the intricacies in Ind AS 19. not the entire Ind AS 19 obviously, but a part of Ind AS 19, especially past service cost and your remeasurement to OCA. These are two critical concepts which we are going to be touching upon right now. So stay tuned, guys. So anyways, I'll just take you through Ind AS 19 basics, but don't worry. But so yeah, just moving on. As per Ind AS 19, the increase in gratuity liability arising due to the application of the new labor codes is a past service cost, as this results in changes to the benefits payable under the plan and treated in accordance with the applicable requirements as below. So why is this a past service cost, guys? Because the very reason being that this number, basically my last round basic getting changed to last round wages, is not on account of change in assumption. It is on account of change in statute. Because of the change in law, this is triggering a change in my liability in the future, which is why this is a past service cost and not a remeasurement. When would it be a remeasurement, guys? Let's say the actuary, that is the management expert who is doing the valuation of the gratuity liability, maybe observes a change in the salary escalation rate, or maybe observes a change in the attrition rate, or maybe observes a change in the discount rate. In that scenario, it would be a change in assumption, and that impact should be taken to OCA as a remeasurement, gain or loss. I hope it is very clear the reason behind why we are taking this change to our past service cost in profit and loss account and not the remeasurement. And if I have to just explain to you the bad text of Ind AS as well, Ind AS 19 requires past service cost to be immediately recognized as an expense in the statement of profit and loss. Past service cost, which is the change in the present value of the defined benefit obligation for employee service in prior periods resulting from a plan amendment, the introduction or withdrawal of or changes to a defined benefit plan, or a curtailment, that is a significant reduction by the entity in the number of employees covered by a plan. So basically in our case, there is a plan amendment which is happening and not a curtailment. Why is it a plan amendment? The introduction of or withdrawal of changes to a defined benefit plan. What is happening here? That is basically an introduction of change and a withdrawal of change. So what is the withdrawal here happening? The withdrawal is that your last round basic would not be used for the computation, and the introduction is that your last round wages would be used for the computation. I hope it is very, very, very clear, guys. Right? Okay, so now we got the answer that, okay, the change has to be taken to past service cost. But why are we even in this video? You can just exit this video right away, right? But that's not so simple, guys. It looks straightforward, but it's not straightforward, because there can be a scenario where a certain portion would have to go to past service cost, while a certain portion would have to go to remeasurement in OCA. You're confused, right? I know you're confused. Don't worry, guys. I've got you covered on this. I've got a numerical example for you. And guys, if you're watching till now, do comment down below that you're watching and on this video, and do comment a fire emoji. So this will motivate me further, right? So next, would you consider the same entirely as a past service cost? Okay, let's understand this through an example by getting an understanding of how an actuary would deal with this. Why do we need to understand how an actuary would deal with this, guys? Because ultimately, we being auditors, you also would need to interact with the actuary to get an understanding of what he or she has done. So only when we know to a broad extent on what an actuary does, I'm not saying we should understand elaborately on what an actuary does. That is not possible for us because we are not qualified actuaries. But at least if we have a broad knowledge of what an actuary does, and if we are able to correlate that with Ind AS 19, we would be able to ask the right set of questions to the actuary and get satisfactory responses. I hope that is very clear, guys. So basically, guys, let's say we have 50 employees in our company. Let's say we have 50 employees in our company, and let's say these are the dates of joining for these employees, and let's say this is the date of birth for the employees, and let's say this is the retirement age. Like, let's say, for example, for employee 1, the date of joining is 31st October 2020. Let's say 31st March 2026 is the financial year end. So in this case, what would happen is, as on 31st March 2026, employee 1 would have completed 5.42 years. How do we get this number? Basically, 31st March 2026 minus 31st October 2020 would give you the number of days. When you divide that by 365, that would automatically get converted into years. I hope that is very clear. And let's say employee 1 was born on 28th September 1970. When would he retire, guys? At the age of 60, assuming that the company policy is 60. So he would ideally be retiring on 28th September 2030, assuming that he works till the age of 60. Perfect? Yes, sir. Total expected remaining service. So what do I mean by this, guys? So basically, I intend to say that as on 31st March 2026, till his retirement age, let's say the employee 1 works till his retirement age, till the age of 60. How long would he work? In the sense, like, basically, what is the difference between 28th September 2030 and 31st March 2026? This would come to 4.5 years. In the sense, what they are saying is, as on 31st March 2026, employee 1 would work for an additional tenure of 4.5 years till his retirement date, right? I hope that is very clear. Total remaining service years. What does this basically mean, guys? When the employee joined on 31st October 2020, he knew that, okay, I'm going to attain the age of 60 on 28th September 2030. So I would need to work for 9.92 years. So when employee 1 joined the company on 31st October 2020, he knew for a fact that he would have to work for close to 10 years of time till the time he attains the age of 60. I hope that is very clear, guys. So basically, we are just doing these computations here. We are just basically trying to understand how many more years of service are remaining for the employee by basically comparing the retirement date for the employees minus 31st March 2026, which is our financial year end in our case. So this is what we are basically doing in column G. So on an average, if you see, we are getting 5.23 years, which basically means that for all the employees, if we ask all the employees of the company to come on 31st March 2026 and stand in a line, all of them are going to say that on an average, we have 5 years to complete till our retirement, right? I hope that is very clear. I hope this number is very clear, guys. Okay, next, years completed as on March 31, 2026. Basically, this means that it's been, for example, let's take employee 1, 5.42 years. This is basically the difference between 31st March 2026 minus 31st October 2020, which would yield us the number of days. And to get the number of years, we divide the same by 365, which comes to a number of 5.42. So what would employee 1 say? As on 31st March 2026, I've almost completed 5.5 years with the company, right? Very clear? Yes. So if we ask all the employees, all the 50 employees of the company to stand in a line, all of them are going to say that, okay, as on 31st March 2026, we have completed close to 6 years in the company, because 5.67 tends to 6. So they are going to say that, okay, we have almost completed 6 years in the company, and we have almost 5 more years left in the company. So on an average, if I have to just put this in language, I'll say that we understand that the employees on an average are expected to work for a total of 11 years in the company, out of which 6 years of work has been completed, which is basically here. So since 6 years have already been completed, the employees are left with 5 more years on an average. I hope that is very, very clear, guys. Yes. So basically, we just need to understand that the actuary will do the working for gratuity at an employee level. Basically, he will do the last round wages into 15 by 26 into completed years of service, and he would do some discounting using the present value factor. That computation, we will just go to that in a while. So the actuary would do this working on an employee level, guys. That's what I've mentioned here. Actuary would do this on an employee level, and once he does this for each of the employees, and then he will aggregate each of the individual employees and arrive at the total impact to be given. But now, guys, for simplicity purposes and for understanding purposes, we are doing it at a totality level. So don't get confused, guys. So we are doing it at a totality level for understanding reasons, but an actuary would be doing it at employee level. I hope that is very clear, guys. That's what I've stated here clearly. For simplicity purposes, we are calculating at an overall level, right? Yeah. So basically, guys, let's say we took the remuneration. Let's say for employee 1, the remuneration is 1,20,000 per month. For employee 2, it is 1 lakh. For employee 3, it is 80,000. For employee 49, it is 1,25,000. For employee 50, it is 75,000. On an average, if I have to tell you, or sorry, this is the annual remuneration, guys. Sorry. So on an average, if I have to tell you, the average remuneration per employee comes to 1 lakh rupees. Perfect. Yes, sir. It comes to 1 lakh rupees. Very perfect. Yes, right. So on an average, the average remuneration per employee comes to 1 lakh rupees. So basically, if I have to tell you here, the basic plus DA, let's say out of this 1 lakh, the basic plus DA comes to 35,000. Let's say the remaining 65,000 pertains to something like HRA, leave travel allowance, which should not be included in the definition of wages, right? Perfect. Yes. So this comes to 35,000. So guys, basically now what we understand is that the gratuity should be computed on 35,000, right? No, we are wrong here, guys. Why are we wrong, guys? Because this is not 50%. So ideally the gratuity should be computed on 50%, which should come to 50,000, right? Yes, that should be the case. But the example is not yet over, guys. Let us say let us say the company expected a salary increase of 12% in 2026, or they actually expected a salary increase of 12% from 2025 to 2026, right? But what has actually happened is the company has actually increased the salary by 15% from 2025 to 2026. So what would happen because of this? The actuary would have expected the salary to be 1,12,000 on an average as on 31st March 2026. But what has actually happened is the salary total remuneration has become 1,15,000. So the salary expectation was 12%, but actual salary increment happened to the tune of 15%. I hope that is clear, guys. So basically, since the new average remuneration is 1,15,000, 50% of this should be my basic plus DA, right? Because that is what we discussed in the previous slide, right? Perfect. Yes. So 57,500 should be my basic plus DA. I hope that is very, very clear, guys. So if you see here, guys, the increase in wages. So if I have to just tell you, this is for the year 2025. And now we are looking at 2026. So if you see the increase in wages, guys, the increase in wages basically is coming to 22,500, because the increase in wages is from 35,000 to 57,500. 22,500 is the increase in wages. But guys, we cannot straight away say that this entire 22,500 should be taken to past service cost. Why can't we say that, guys? Because that was a change in the assumption that happened, because initial expectation was 12% salary increment, but the salary increment that actually happened was 15%. So we cannot directly say that this 22,500 should entirely go to past service cost in P&L. So one part of this 22,500 has to go to OC and the other part has to go to past service cost. I hope we are very clear on this, guys. Right? So yes, so that is what I've exactly said here. First, the salary increase of 12% plus the extra 3%. This component should be taken to OCI because this is due to change in assumptions. This should be go on as a remeasurement item in OCI. I hope that is very clear. Next, second, the restructuring of salary, that is making this as 50% of the total remuneration. This should go to past service cost in P&L because this is on account of the new labor code which led to a restructuring and which should be taken to past service cost as per Ind AS 19. Right? Yes, perfect, sir. So we now need to break this 22,500 into two components, basically into the past service cost component and the OCI component, right? Clear, perfect, yes. So first, let's compute the past service cost component, right? So if I have to just tell you guys, the increased average wages. So basically what should have happened is, ideally, my average wages should have increased by 35,000 plus 12%. Assuming that the salary escalation actually happened at 12%, it would have been 39,200. And the earlier wages were 35,000. So there is an increase to the extent of 4,200. This should go to OCI for sure. Perfect. Yes, sir. But beyond this, there is also a change in assumption. What is the change in assumption, sir? The change in assumption is that the salary increment that was expected was 12%, but the salary increment that actually took place was 15%. So this 3% excess should also be taken to OCI. So how does this 3% excess go to OCI, guys? Basically, if you see here, my average remuneration per employee is 1 lakh. And if I apply 3% on that, that would come to 3,000. So due to change in actual assumption, the amount would come to 7,200. Now you guys would have a doubt. What would the doubt be, sir? Basically, why can't we directly do 35,000 plus 15%? Why won't we get the same answer? This is not correct, guys. Let me just do that and explain to you the reason behind the same. If I do this and if I take 35,000 here and if I just take 35,000 here and just see the difference. So I would basically need to take an amount of 5250 to OCI, but here we are taking 7200 to OCI. Why is the reason behind? What is the reason behind that, guys? Guys, if you see here, basically the logic is that if whenever there is a salary increment over and above the expectation, what would usually happen is that amount would be on the basic component. So basically, what is the procedure here is that the 3% increment over and above the 12% is on account of the basic increase, because what will happen is your salary increment usually happens on the basic component, guys. So this 3%, when I apply it on 1 lakh, so when I'm just trying to say that this 3% is entirely attributable to basic. When I'm applying the 15% on 35,000, what is happening is that I am not saying that it is entirely attributable to basic. I am saying that one portion of the 3% is attributable to basic. But the true picture is that the entire 3%, which is happening here over and above the expectation, 1 lakh into 3%, 3,000, this entirely should go to basic because your salary escalation usually happens on your basic figure. That is what I've said here, saying that over and above this, there is an increase in the salary increment rate by 3%, which would fully go to wages, as the basic value will be increased in case of salary increment. And where is your basic included? Your basic should be under wages as per the definition, which is why entirely this 3,000 is being taken instead of doing 35,000 plus 15%, which is why you are breaking down it into 35,000 plus 12% first, then directly applying the 3% on the total remuneration, leading us to a figure of 7,200, which is the change in actuarial assumption. I hope it is very clear, guys. Next, if I just come down. Gratuity formula used by the actuary. So what would the actuary do here, guys? Very simple. So before that, so we understood that, okay, out of this 22,500, 7,200 is due to a change in actuarial assumption. And obviously the remaining is going to go to past service cost, because past service cost, the P&L impact is going to be residual, because we know what is the assumption. So anything that is over and above the assumption change is going to go to past service cost to the extent of 15,300. I hope that is very clear, guys. Okay, right. Okay, guys. So now you guys might be thinking, okay, so 7,200 should go to OCI and 15,300 should go to P&L, or maybe 7,200 into 50 plus 15,300 into 50, because we have 50 employees in the company, as we discussed, right? No, guys, it does not end here, because we need to do the present value computation. We need to apply the gratuity formula here. There is a lot more to be done. This is not how things work through an actuary, because there is something called present value factor, and we need to do that. I just explained that to you, right? So okay, first let's compute the OCI impact, guys. If I just come down here, gratuity impact is equal to increase in last on wages into 15 by 26 into years of service complete. So how do I first I need my last on wages, guys. you guys might say that, okay, I can directly take so you guys might say that, okay, I can directly take 7,200 as my last round increase in last round wages. No guys, you cannot directly take 7,200 as my increase in last round wages, because as I told you guys, 6 years have been completed for all the employees on an average, right? So 5 more years on an average are left. So basically, gratuity, as all of you are aware, gratuity happens at the time when an employee leaves the organization. Assuming that all the employees of the company on an average would leave after 5 years, so the gratuity would be paid at the wage rate prevailing at the time. So the last round wage would be the wage rate prevailing after 5 years. So we need to see what can be the wage rate prevailing after 5 years. If I just come here, guys, the wage rate that could be prevailing after 5 years would be basically 7,200 plus my increment rate. What is my increment rate? 6%. But sir, we saw that the increment rate was 15%. Guys, the increment rate which we saw as 15% was in the current year, like based on the expectation change. But this 6% which we are seeing here, we are expecting that 6% to happen over the course of the next 5 years, because the gratuity liability is going to be settled at the end of 5 years from here, because we are at the 6th year right now and we have 5 more years left on an average for all the employees. So basically, we need to see what is the salary escalation rate expected over the 5 years. This will be given in the actuary report by the actuary, and we need to discuss with the HR and the management. And we also need to see the past trends on what has happened. Maybe the 15% in the current year could have been a one-off case, but on an average, it could be 6% or maybe 5.5% or 5.9%, due to which the actuary is maybe taking an assumption of 6%. So we need to discuss the same with the actuary and the management and get comfort over the same. I hope that is very clear, guys. So that is what we need to do. So if you see here, guys, basically 7,200 into 1 plus 6% power 5. Why power 5? Because we need to see how much would be the increment year on year. Basically, the compound interest formula, P into 1 plus R power n. That is what we are basically doing here, because we need to see the amount after 5 years, what this would accumulate to, right? So that is why we are getting a number of 9635 here. Okay, an increase in projected gratuity at the exit. So what would this be, guys? This is basically my increase in last round wages, which is basically 9635 here, into 15 by 26 into years of service completed, into 15 by 26 into 6, because 6 years have been completed, guys. Because as we saw earlier, on an average, all the employees had completed 5.67 years, which can be rounded off to 6 years. I hope that is very clear. So that is what is happening here, guys. So basically, what will happen is, and this amount needs to be discounted, guys. Why does this need to be discounted? Because this amount is going to be paid after 5 years. We need to bring it to today's terms. So we need to apply the present value factor for 5 years. And what is the discount rate that we need to take? So we can basically take the discount rate of interest rate of a government bond, right? That is what your Ind AS 19 suggests you to do. So this you can take from any site, published site, like, or any reputed site like investing.com. Again, on this we can do a deep dive, guys, and on how to audit the actual assumptions in detail, I can do another video, but that is not the intention of this video. So let's say it comes to 7.25%, and let's say you as an auditor have also verified the same, and you get comfort over the assumption of 7.25%. What would happen here? Basically 1 by 1.0725 power 5, basically 1 by 1 plus 0.725 power 5. That is what we are doing here, guys, basically. So that is what is happening here. That is what we have done here, which is giving us a number of 0.705. So basically, when we multiply 33,353 with 0.705, we get a number of 23,504. And when we multiply this with 50, which is basically the number of employees in the company, we get this number of 11,75,207. So this is basically the number that needs to be taken to OCI. Similarly, we need to do this computation for the past service cost number of 15,300. Basically, we need to apply the gratuity formula and we need to bring it to the present value term, right? Okay, so coming here, basically you just come here. So 15,300 is the past service cost number. We need to see how much would be the impact after 5 years, because we are in the 6th year and the amount would be settled at the end of the 11th year, which is 5 more years ahead. So again, we basically do 15,300 into 1 plus 6% power 5, which is what we have done here. Next, increase in projected gratuity at exit, which is what is the formula for gratuity, guys? What gratuity can be expected to be paid? Basically, your last round wages 2475 into 15 by 26 into 6, because 6 is the completed years of service, right? Perfect. Yes, sir. That is the completed years of service. So that is what we're going to be taking here. And a discount factor for 5 years at 7.25%. Again, it's the same number, 0.705. And when we multiply 7874 with 0.705, we are going to get a number of 49,946. And again, when we multiply this with 50, we're going to get the P&L impact for 50 employees. I hope that is clear, guys. Yes, perfect. Okay. Now, just coming to our example, guys. So let's say our opening gratuity liability as at April 1, 2025 is 70 lakhs. So this we are going to be looking at it below, guys. Not now, just give me a moment. We'll just be looking at it in a while. So meanwhile, guys, there is something called current service cost. As you all are aware, current service cost is the cost that is attributable to 1 year of service. So let us say, how would this work, guys? This would basically be your average wage into 15 by 26 into completed years of service into present value factors for 5 years, because again only 5 more years are remaining, so I need to bring it back to the present, right? Perfect. Yes, sir. My average wage is 57,500, guys. You might be having a doubt, sir. We are taking, in the earlier cases we are taking 7,200 and 15,500. That was because that is the direct number which we took for remeasurement and our past service cost. But here we are looking at the average wage. There we were looking at the increase or the decrease. There we were looking at the increase, to be precise. But here we are looking at the average wage, which is derived using our projected credit unit method, which is basically 57,500, guys, which is our average wage, which should be taken for a gratuity computation. So we are saying that 57,500 is the average wage, and assuming an escalation of 6% at the end of 5 years, we're going to say that, okay, at the end of 5 years, the average wage is going to come to somewhere around 76,948, because this is going to be the amount that is going to be the last on average wage at the end of 5 years. So when I come to my past service cost impact, I'm going to basically say 15 by 26 into 76,948 into 0.705. I'm not going to multiply it with 5, guys, because I am looking at this only for the current year. Current services cost is only for the current year, so it should ideally be multiplied only by 1, and anything multiplied by 1 is going to yield the same number, right? Which is why we are not doing anything here. So it would basically be 15 by 26 into my current service cost, which I'm going to expect to pay at the end of the 11th year, which is 5 years away, into the present value factor for 5 years, because we have completed 6 years, 5 more years are remaining to go to the 11th year. So present value factor of the 5th for 5 years, which we are taking here, which gives us a number of 31,284. Basically, again, for 50 employees, I would derive a number of 15,64,223. So when I just come to my opening, guys, my opening is 70 lakhs, which we trace to our last year financial statements or maybe our last year actual report. There are interests, which is basically going to be applied on our opening balance at 7.25%, which is basically 70 lakhs into 7.25%, which gives us a number of 5,07,500. Current service cost, which we just computed right now, 15,64,223. Remeasurement again, which we saw 11,75,207. Past service cost comes to, let's say, 24,97,316. And let's say some employees would have left during the year, right? We would have paid them gratuity. What would have been the journal entry? Basically, my gratuity liability debit to bank to the extent of 20 lakhs. So I get a closing balance of maybe 1,07,44,246, guys, right? Yes. So out of this, the number that would be going to P&L is basically this plus, sorry, that's it. So 45,69,038 would go to P&L, and in my OC, the number would be 11,75,207, right? I hope that is clear. So, okay, so how does the deferred tax work on this, guys? So as you all are aware, as per Ind AS 12, my tax base for an item like gratuity is 0, because my income tax does not recognize an item like gratuity on its balance sheet. So basically my tax base is going to be 0, and gratuity being a liability, since the book base is going to exceed the tax base, it would lead to a deferred tax asset. Deferred tax asset requires to be created. So if I basically see how much of the deferred tax asset is required to be created, you see this is the closing balance, 1,07 lakh minus 70 lakh into 25.17%, which is basically the tax rate applicable to a company in the alternate tax regime, right? So this is going to be the number that is coming. Let's say the OC impact for deferred tax. So how do we, so basically this 9,42,427, out of this, one portion would go to OC and the other would go to P&L. Which portion would go to OC? Your OC portion would basically be your 11,75,207 into 25.17%. This component is going to go to OCI as deferred tax. And the remaining, which is basically 9,42,427 minus 2,95,800 would go to my P&L on account of deferred tax credit, which is basically the entry for this would be deferred tax asset debit to P&L. And for this one, it would be basically my deferred tax asset debit to OCI. That is going to be the entry that is going to be passed. I hope it's very clear, guys. Okay. And one more very important thing which you need to ensure, guys, we saw this computation for our whole term employees. For fixed term employees, they become eligible for gratuity upon completing just 1 year of service. So let's say your company hires, let's say the client which you're auditing, they hire employees on a contractual basis, like let's say for a term of 3 years. In that case, the employee would be eligible for gratuity just upon completing 1 year itself, guys. So in that case, the gratuity accrual needs to happen, assuming even after the employee completes 1 year of service, right? So that is something you need to keep in mind, and a similar computation has to be done similar to what we did above, just that it would be 1 year in this case, because the employee would be eligible for gratuity upon completion of 1 year of continuous service. I hope that is clear. In case the company which you're auditing does not have any fixed term employees, in the sense in their offer letter there is no contractual period mentioned, that is if they are full term employees, you don't need to worry about this at all. It wouldn't be applicable to your company. I hope that is very clear, guys. Okay, yeah. Now let's just move on to the FAQs that are issued by ICAI, guys. Let's just read them up. Just give me a minute, guys. Let's just read them up. Just a minute. Yeah, just a minute. Okay, so as we were earlier discussing, so continuing on the crux of the ICAI FAQs on the new labor code. So basically, we had discussed some of the points already as a part of our discussion. So there are some more points in the FAQ which are remaining. Like for example, if I just have to take you through the FAQs here, basically the first point here is in relation to whether the same should be recognized as past service cost or remeasurement, which we already discussed. And the second question here is in relation to whether which component should go to past service cost and which component should go to remeasurement in OCI, which again we had discussed. And the third question is basically the labor codes are notified on 21st November 2025, but most of the states are yet to notify the labor rules actually. So is the code still effective from 21st November 2025 despite this fact? Yes, it is still effective is what they are saying here. And this will have an impact on your results for the period ending 31st December 2025 and for your year and for your financial 31st March 2026. So one question in this is, guys, can we defer the impact? Can we defer some portion of the amount to 31st March 2026 is what they are asking here. So if I just have to explain to you guys what they are exactly asking. So what they are saying is, for example, in our case, we saw that the past service cost came out to 24,97,316, right? Perfect. Yes. What they're basically saying is this 24,97,316, can we take some portion of this to March and can we take some portion of this to December quarter? How do we do this? Basically, if you just see the labor code was notified on 21st November 2025. And let's say the gap between 31st December 2025 and 21st November 2025 comes to 41 days. And if you look at the gap between 31st December 2025 and 31st March 2026, it comes out to 90 days. So basically, it is saying whether we can do 24,97,316 into 41 by 131 for the December quarter and 24,97,316 into 90 by 131 for the March quarter. So basically prorating the amount across 2 quarters. So we cannot do this, guys, because we need to understand the logic behind Ind AS 34 here. So basically Ind AS 34 states that whatever accounting policy you are applying in your annual financial statements, that should be applied in your interim financial statements as well. And more importantly, even important is that measurements for interim reporting purposes, whatever I've highlighted in bold, I'm just reading that measurements for interim reporting purposes shall be made on a year-to-date basis. Further, as per paragraph 39 of Ind AS 34, costs that are incurred unevenly during an entity's financial year shall be anticipated or deferred for interim reporting purposes if and only if it is also appropriate to anticipate or defer that type of cost at the end of the financial year. So like for example, this 24,97,316 which we saw, we did that computation for March 31, 2026. But here we are just, for example's sake, we are saying that it pertains to December. Like if we do the similar computation for December and let's say we get this number, that is what we are referring to here. So this point is saying that this 24,97,316, if your Ind AS 19 allows you to defer it to maybe the next financial year, like does your Ind AS 19 allow you to defer this 24,97,316 to a financial year beyond March 31, 2026? No, guys, your Ind AS 19 tells you that the past service cost should be immediately recognized in P&L, right? Yes, it should be recognized immediately in March 31, 2026 itself is what we also understood in the previous tab, right? So what your Ind AS 34 is basically saying here is that since your Ind AS 19 does not allow you to defer it in the context of an year, your interim reporting period, that is your period of 9 months of from April to December, should also be treated like an year. It should be treated on par with the financial year. And since it is treated on par with the financial year, since you cannot defer for a financial year, you also cannot defer for this period. So you have to recognize the entire amount in your December quarter itself, and you cannot defer 7 lakhs here and 17 lakhs in the next quarter. You have to take this entire amount in December quarter itself. So that is what they are trying to say here. I hope that is very clear, guys. Next point. Next FAQ, if I just come down a bit, whether an increase in gratuity liability arising from the new labor code should be treated as an adjusting or a non-adjusting event in the financial statements. So basically, this is more in the context, like that is example financial statements or results for the period ended 30th September 2025 or 30th June 2025 and 31st March 2025. This is referring to the prior periods, guys. Like, let me just explain this to you through an example. Let's say you are doing the start audit for an entity for financial 24-25. Let's say the due date to complete the start audit is 30th September 2025, but due to some issues in the client, you are not able to complete the audit, and the audit is still ongoing for financial 24-25. Let's say even in January, you're not able to complete the audit. In that scenario, what they're saying is since we have gone past 21st November 2025, the date on which the new labor code was notified, should we also take the impact of like for example, let's take an item like gratuity. Like under the previous laws, you would have to do it on last on basic into 15 by 26. But now, as per the new labor code, you would have to do it on last on wages into 15 by 26. So they are asking for the financial year 24-25, where your audit is under an extension, should you do it on your last on wages? No, guys, this is not an adjusting event for periods like financial year 24-25 or your 30th June 2025 ending quarter or your 30th September 2025 ending quarter, because the period has already gotten over. Only after the reporting period is over has the new labor code been notified. Merely because the audit report has not yet been signed, or merely because there is an extension in the audit completion, you cannot take it as an adjusting event, is what they're trying to say. But that should be a disclosure in your notes to account stating that on 21st November 2025, the government of India notified the new labor codes, the impact of which has not been taken in the current financial statements because of the fact that the current financial statements pertain to a period earlier than 21st November 2025, and the fact that the management is assessing the impact of the same on the subsequent financial statements, and the same would be incorporated in the subsequent financial statements. Like maybe the earliest period in which this would be incorporated is for the 9 months ending 31st December 2025. I hope that is very clear, guys. I hope you got an understanding of what the FAQ number 4 is, right? Yeah, just coming down. Next, let's just come to question number 5. Like gratuity, the new labor codes are likely to have an impact on leave obligation for the entities. How should an entity account changes in leave obligation arising from the new labor codes? So basically, it's the same as gratuity, guys. That's exactly what they're trying to say. Like you have to immediately recognize the expenses, what they're trying to say. Question 6. Can an entity present additional expense resulting from an increase in gratuity or leave obligation due to the new labor codes as an exceptional item in the statement of profit and loss? So guys, basically what is happening is, if I'm not going to read the entire thing, you can, maybe I can just attach this in the description for you. I'll just explain to you a crux of what is stated here. So basically they are saying that the term exceptional item is neither defined in your schedule 3 nor in Ind AS. But in Ind AS 1, presentation of financial statements has a definition for material items in paragraphs 85, 86, 97 and 98. So basically paragraph 85 says that when an item is relevant to the user's understanding of financial performance, it should be presented separately. Then your paragraph 86 states that if the item helps in making financial projections for the future performance, then it should be presented separately. So what they are saying is that an entity should consider factors including materiality and the nature and function of the items and of income and expense before presenting them separately. Then your paragraph 97 states that when an item of income or expense is material, the entity should disclose the amount and nature separately. Paragraph 98 states that circumstances that would give rise to the separate disclosures of income and expense include. So basically your paragraph 97 is saying that when an item is material, it should be stated separately. That is the nature of the item and the amount should be stated separately. In our case, like let's say the past service cost came out to 24,97,316, we should say that the past service cost on account of change in the new labor code is 24,97,316 separately. That is what they're saying. You have to highlight and show it separately is what they're saying. And paragraph 98 is giving you an indicative or an illustrative list of items that are usually presented separately, considering materiality. So if I just have to give you examples like write down of inventories or your property, plant, equipment reversals or write downs, then your restructurings, then your disposal of property, plant, equipment, disposal of investments, then your discontinued operations, litigation settlements, and other reversals of provisions. If you see here, Ind AS 19 or past service cost is not here. Does that mean that it is not material? No, guys. As I told you earlier, this is just an illustrative list or an inclusive list. So this is just an example or an indicative list. So anything and everything that you feel material can be presented separately and should be presented separately, right? Next, as for Ind AS 1, information is material if omitting, misstating, or obscuring it could reasonably be expected to influence decisions that primary users of general purpose financial statements make on the basis of those financial statements, which provide financial information about a specific reporting entity. What they're saying is the information is regarded as material. You should see it from the user standpoint. Like if you as a user would feel that if the information is not shown, that is if the past service cost is not shown separately, you would be misled. You would get misled by that. If you as a user feel that, if you in the shoes of user feel that you're going to feel misled because the information was not presented separately, then you should regard that item as material. That's what they're trying to say here. I hope that's clear, guys. Next, materiality depends on the nature or magnitude of information or both. So this is very, very important, guys. So what they're basically trying to say is just because an item is not material in terms of number, it does not mean it is immaterial. You also have to see the nature of the item, like something like a one-off item. In our case, if you look at the past service cost, it's a one-off item. It could even be immaterial at times. I know like it is going to have a material impact on the financial statements, but theoretically, let's say the number is immaterial. But just because the quantitatively it is immaterial does not mean it is immaterial. It is a non-recurring item, and by nature or qualitatively, if I have to say, it is a material item. Next, an entity assesses whether information, either individually or in combination with other information, is material in the context of its financial statements taken as whole. So it is basically saying that an entity has to assess whether this past service cost impact is material in the context of the entire financial statements as a whole. Right. Next, from the above, it appears that all material items are not exceptional items. So what they're trying to basically say here is material items is the superset, exceptional item is the subset. It is saying that exceptional items are those items which meet the test of materiality, that is size and nature, and test of incidence. So what they're saying is for an item to be regarded as exceptional, it should be material both quantity wise and quality wise, right? One may argue that change in gratuity and leave obligation is arising from enactment of new legislation, which is an event of non-recurring nature. Considering this, and depending on materiality of impact, an entity may evaluate whether it is acceptable to present additional expense resulting from increase in gratuity or leave obligation due to the new labor codes as an exceptional item in the statement of profit and loss. Irrespective of whether the expense is presented as an exceptional item, the entity should make relevant disclosures to explain the impact arising from the enactment of the new labor codes. So what they're saying is, if you as an entity or if you as the management feel that the item is not material, you need not present it as an exceptional item. But in your notes to accounts, you need to state that because of the change in the new labor code, there has been an impact in the P&L to this extent. Like, see guys, in a case where it was a non-adjusting event itself, we gave a disclosure, but here it is an adjusting event. Here it is impacting your financial statement. So you should obviously disclose it in the notes to accounts. So that's what they're trying to say here, guys. Question 7 is on deferred tax, which we already saw for our gratuity. So I'm not discussing that further. And for I've taken TCS results for quarter ended December 2025. We can just go through that. Like we can just see how they have presented the impact of the new labor code. Now we just come down. They are saying statutory impact of new labor codes. Note number 23, 2128 crores, 2128 crores, guys. Look at this. So the profit of the entity is 14,000 crores, and this number is 2128 crores. If you look at this, this is actually more than 10% of the profit, guys. It's a very, very big number impact. So that is what they're trying to say here. TCS has presented it as an exceptional item because it is obviously material. We as users prima facie know that. So the management would obviously know that. Note 23. On November 21, 2025, the Government of India notified the 4 labor codes, the Code on Wages 2019, the Industrial Relations Code 2020, the Code on Social Security 2020, and the Occupational Safety, Health and Working Conditions Code 2020, consolidating 29 existing labor laws. Exactly. So 29 labor laws were consolidated into 4 new labor codes. The Ministry of Labour and Employment published draft central rules and FAQs to enable assessment of the financial impact due to changes in regulations. The group has assessed and disclosed the incremental impact of these changes on the basis of legal opinion obtained and the best information available, consistent with the guidance provided by the Institute of Chartered Accountants of India. Considering the materiality and regulatory driven non-recurring nature of this impact, the group has presented such incremental impact as statutory impact of new labor codes under exceptional items in the consolidated interim statement of profit and loss for the period ended December 31, 2028. So what they're basically saying is that, again, the company has sought guidance from the FAQs issued by ICAI, which we are just seeing right now. And it is saying that the company feels that the item is material nature, which is why they've taken it to exceptional items. And next point, the incremental impact consisting of gratuity of 1816 crores and long-term compensated absence of 312 crores primarily arises due to change in weight definition. So basically, they have broken that 2128 into 2 components, 1816 for gratuity and 312 for leave encashment long-term. The group continues to monitor the finalization of central or state rules and clarifications from the government on other aspects of the labor code and would provide appropriate accounting effect on the basis of such developments as needed. So why are they saying this? Because if you look at some of the states, they have not yet notified the labor rules, guys, so which is why they are stating this point that if any further change comes or if any of the state rules get introduced or if there is any amendment in the state rules which are already prevailing, they would also factor that in to consider the financial impact on the financial statements as a whole. That's what they're trying to say here. I hope it is very clear, guys. Guys, I hope you found this session insightful and really enriching because a lot of effort has gone behind the making of this session, guys. A lot of analysis, a lot of discussions have gone in the making of the session. I hope you found this insightful, guys. I know there is still a lot to discuss on the labor code, like the impact of PF on the financial statements, the impact of even your contract labor. That is something really, really important and open for discussion. So guys, if you want any specific topic on the labor code which could have a potential impact on the financial statements as a whole, do comment that down below and I will definitely consider making that into a video, like something like your impact of PF or impact of contract labor changes on the labor code or on the financial statements of the entity. Do comment that down below and I will definitely consider doing that, guys. I hope you found the session really insightful, guys. This would be really, really useful if you're doing the limited review for any entity for the quarter ended December 2025, or if you're going to be assigned this area of benefits for the statutory audit for the financial year 25-26. So do share this with anyone who might need this or who might find this insightful, guys. Do share it with your seniors, colleagues, friends, and do keep learning and growing. And I hope you found the session insightful, guys. And if you was still here, if you was till the end, do comment down below what you felt about the session, and do comment down below if you have any doubts. More than happy to clarify the same. And I'm really happy if you hung in till here. You are a true warrior. So thank you so much for hanging in till the end. Keep learning, keep growing, and do share this with someone who might need this, right? Cheers. Thank you so much. Take care. Bye-bye. Thank you, guys. Bye-bye. Thank you.